Think Realty Nation, it's your host, Abhi Golhar. Welcome to the Think Realty podcast. Excited to be here with you today. I love this topic, the topic of tax deductions for real estate investors. And when you think tax deductions, you think building wealth. And when you think building wealth, you think WealthAbility. When you think WealthAbility, you think Tom Wheelwright, who's our guest for the show today. And it's going to be a good one because this is information that you real estate investors need to know right now so that you can benefit from the 5 biggest tax deductions for real estate investors. So we're going to talk about that. And then we're going to have a short break, and then we're going to talk about winning the game of real estate investing, setting the right goals. Because if you're a new real estate investor, let's face it, sometimes you don't even know what goals to set. And if you're a pro real estate investor, let's face it, you're too busy to set goals. So we're going to have that conversation. But first, I want to thank our sponsor for today's podcast. Today's podcast is brought to you by Norada Real Estate Investments, your premier source for cash flow investment property. Go ahead and go online to visit www.turnkeyrealestateinvestments.com. That's my bad, Marco. I'll make it up to you. www.turnkeyrealestateinvestments.com. Mr. Wheelwright, I'm excited to have this conversation with you. It is awesome to have you on. First of all, welcome to the show.
Thanks very much, Abhi. Always good to be with you.
All right, likewise. So tell us a little bit about who you are and what you do for those of our listeners and those of our viewers that don't already know who you are.
Absolutely. So I'm best known for my book, Tax-Free Wealth, bestseller for the last 7 years on Amazon and in bookstores. And my background is I have an undergraduate in accounting from the University of Utah, a master's of tax from the University of Texas. I spent 7 years in Big Four, that's Ernst & Young, including 3 in the national office, 14 years as an adjunct professor in the Master's of Tax program at Arizona State University, 4 years as the in-house tax advisor for a Fortune 500 company, and I have built several CPA firms and currently run a rapidly expanding network of CPA firms that we're up to 20 now and on our way to 100, should be close to 100 by the end of the year, and very excited to be able to serve more people. So, some of you probably know I tend to travel a lot with Mr. Robert Kiyosaki because he's a good friend and client of mine, and we do a lot of speaking around the world. So that's it in a nutshell, Abhi.
Awesome. And you have a really popular podcast. It's called The WealthAbility Show. You can download that on iTunes and, of course, Google Play. I listen to it all the time, and I was telling Tom before the show that I listen to his shows generally 5 or 6 times throughout the day, and the only thing that he said was that it's creepy. And I think that's great. I think that's awesome. I would be creeped out too. It's funny though, like I'm sure you'll walk through airports and you're like, oh my God, that's Tom Wheelwright. He's the guy. And doesn't that creep you out? Like you're like famous. How do you deal with that?
It's a little weird. It's a little weird as a CPA, as a tax guy, right? To be stopped and, somebody talks, I read your stuff. I was at an event the other day and this woman said, well, I read your first book and then I read your second book and I have it on audio and I'm just going, and I listen to your podcast all the time and I'm just going, all right, that's like I said, that's a little creepy, but great.
Awesome. You know what somebody should do is show up to one of your events with like the Utah Utes football team like jersey. And
that would be awesome.
That would be great. And then you'd be like, whoa, this is really freaking me out. Now you know way too much about me.
There you go.
So let's get to these the 5 biggest tax deductions for real estate investors. My audience is real estate investors. They always want to know, how can I minimize my taxes? And so whenever I have questions about this, I turn to you. Let's go ahead and get started. What's number 1, 2, 3, 4, 5, in whichever order you prefer?
Well, I'm going to give them to you in the order of importance. So number 1 is by far and away depreciation. And with this new law, we have bonus depreciation on new and used real estate, which means in a nutshell that if you do what's called a cost segregation, where you hire an engineer accountant to break out the cost of your property between land, building, contents, and land improvements, then you'll end up with a deduction the very first year that you have that building, somewhere in the neighborhood of 25 to 30% of the cost of the building. So if you buy, let's just say you buy $1 million building, you're gonna get a first year deduction easily of $250,000. So you may only put down $200,000 and you get a deduction for $250,000. Because remember, the bank doesn't get the deduction for depreciation, you get the deduction. So this is a pretty amazing tax benefit for real estate. And a lot of people don't understand it. A lot of people are not doing it. A lot of people are not taking advantage of what really is the greatest thing since sliced bread, frankly. If you're a real estate investor not taking advantage of bonus depreciation, you are missing an enormous opportunity to reduce or eliminate your taxes.
So help me understand what cost segregation means, right? Like, so you have some investors. They're like, all right, cool. I understand what depreciation means. What's cost segregation? Like that sounds like something you'd learn in biology class, like segregating something, segregation of.
Right. So it's more likely to learn it in engineering class, because that's what it is. If you think about what you buy when you buy a property, it's obvious you buy the land and the building. Well, by itself, those are two different things, and they're treated differently for tax purposes. Land is not depreciated because it doesn't wear out. Buildings are depreciated. When you buy there's a couple of other things that you also are buying that you may not recognize, that you're really buying more than just those two from a tax standpoint. You're also buying all the land improvements, so the landscaping, the driveways, the carports, the covered parking, the fencing, the outdoor lighting, all of that is classified differently for tax purposes for depreciation than a building. And it's always important, because normally it would be depreciated over 15 years instead of 27 to 40 years. This year, because of the 2017 Tax Act, this year, that's especially important, because instead of being deducted over 15 years, land improvements are deducted in the first year. So they're 100% deducted when you buy the property, well, when you place it in service. The other thing that you buy when you buy properties, you buy all the contents of the building. So you buy the window coverings, you buy the ceiling fans, the lighting, the carpet. All of those things are what we'd refer to as personal property. They're not real property. They're not permanently attached to the building. So they actually get depreciated normally over 5 to 7 years. Again, with bonus depreciation, You get them all in the first year. Now, cost segregation is simply the engineering study done to break out the cost of the property between the contents, the land improvements, the building, really those three things. The land, you have to come up with that on your own, and pretty much you're probably going to use your property tax assessment to come up with what the land value is. But the other three, you've got to have a professional engineer do that cost segregation, or an accountant who can actually has tools to use to break down those costs, and they have to be very detailed.
So we've run through two. We ran through the 100% bonus depreciation, and also that 20% pass-through. We didn't touch on that yet, just real quick. That sounds very interesting to me.
So that's an interesting one. It's really going to be important in the second year you own the building. And Here's why. So basically what you get is 20% of the net income from the property is deductible, subject to certain limitations. So if you take all the depreciation, this actually helps you considerably, because normally, if you took normal depreciation, you'd get, for that 5-year property, the contents, you'd be depreciating pretty heavily over the first 5 years. So you might not have any income the first 5 years, and you would not get the 20% deduction, right? Because 20% of zero is zero.
Right.
However, if you take the bonus depreciation on year one, then the second year, you'll probably have net taxable income from the property. So what do? You get 20%, 20% off the bottom line, 20% off the net taxable income, and that's a deduction, okay? And that's that's a pretty cool opportunity. So it's really pretty simple. I mean, there are some limitations that your accountant will go through when they run your tax return. But just remember, it's 20%. So you're really only being taxed on 80% of your net income.
That's incredible. So we've gone through the 100% bonus depreciation. Where does the 20% pass-through deduction fall in terms of importance? Is that number 2, 3, 4?
I'd say that's number 2, just because while most real estate investors, they may never see, some real estate investors historically have never seen positive net income because they buy properties and they've got depreciation. And for that first 5 years, then they keep buying properties, got depreciation. And so they end up not ever seeing net positive taxable income because of their leverage. However, I think with bonus depreciation, we're going to start to see it. So I think it's a real opportunity. And certainly anybody that has paid off their properties, they're going to see that opportunity too. So I think I actually think it's going to be a pretty big deal.
That sounds like a really big deal. And at this point, if you're listening or you're watching this and you're like, well, geez, I have questions for Tom and his team, what you want to do is go to WealthAbility.com and schedule a free consultation. Like, there's a lot of stuff here that's really heavy that you need an expert to walk you through step by step. And Tom's that expert. I mean, he knows everything when it comes to understanding these deductions. You're a real estate investor, get in touch with him. Again, WealthAbility.com, and then make sure that you're on the site and you can schedule a free consultation. And if you want to keep that conversation going and keep learning, of course, listen to his podcast, the show. It's called The WealthAbility Show. Tom, what's number 3, the third most important deduction that real estate investors are missing right now?
So I actually think the third most important deduction you're missing is probably the home office. And a lot of real estate investors miss that because a lot of real estate investors, they invest in real estate and then they have a full-time job. And so you don't get home office deduction for your job. Even if you actually have an office for your job, you don't get that deduction anymore. So if you're a real estate investor, though, you can have a separate office in your home. Just got to be a separate space. Doesn't even have to be an entire room. And then you get to deduct a proportion of your home related to that home office. Well, what do you have in your home that you're spending money on? Well, you're spending money on maintenance. You're spending money on taxes and interest, which, by the way, now are limited otherwise. But if you get the home office deduction, they're not limited. Now you have your utilities. I mean, your insurance. There's all sorts of expenses of owning a home or renting a home. By the way, you don't have to own it, you can rent it. And a lot of people don't take the home office deduction, and they don't take it for 2 reasons. The first reason is their accountant says, oh, that is a red flag. Do not take that home office deduction.
Yeah.
That's like scary. You're going to get an audit. I'm going, yeah, it doesn't work that way. If you have a good tax preparer, frankly, if you do it right, there's no reason the IRS would even know that you have a home office. So it's certainly not a red flag like it used to be. If you're smart in the way you prepare your tax return, and it's an enormous deduction. And on top of that, it affects the number 4 deduction, which is your automobile. So typically, if you're a real estate investor, you're going out to see properties, you're visiting properties, whether you manage them or somebody else manages them, you're still going by the properties. And so you do drive. Now, here's the challenge. The challenge is that you may drive to see your property on the way to work. Well, okay. Remember, you get an automobile deduction for the mileage you drive for business purposes. But that first trip during the day is not business. That's a commute. So let's say that you go from your home to your property. That's a commute. If you go from your property to your W-2 job, that's also not business, right? So you may have very little business expense on your car, business mileage, if you are like most people. However, what the IRS says, and it's very clear even in their instructions, is that if you instead have a home office and you go from that home office to your first, to see your property, that's not a commute anymore, because your commute now is the 30 feet from your kitchen to your home office. And then at night, when you come back, even from now, if you come back and you stop by a different property on the way home, okay, now if you come from your W-2 job, okay, that's again, that could be a commute. But if you go now to another property and you visit that property and you come home, now that's also not a commute. And so therefore that is now tax deductible. And that's particularly important because under this new law, we got a lot bigger deduction for cars than we used to have. We used to have a little teeny tiny deduction. I mean, like the most you could get was like $3,500 a year.
Yeah, okay? I remember that. Yeah.
Now, if just driving a normal car the very first year you own it, you get up to an $18,000 deduction. So it's way bigger deduction if it's used for business. And then on top of that, if it's an SUV, a big SUV or a truck, which a lot of real estate investors drive big SUVs and trucks.
Yeah.
If it's one of those, you might even qualify for bonus depreciation, where you get to deduct the entire cost of the vehicle the year you buy it. Even if you don't put any money down, you get the entire cost of the vehicle. So you go out and buy an $80,000 truck. That's not hard to do these days.
Right.
You go buy an $80,000 truck. Let's say you use it 80% for business because you have a home office, right?
Yeah.
80% for business. That means you're getting a $64,000 deduction that you buy that car, and you might have put down nothing. Well, $64,000, even in a 30% tax bracket, is over $20,000 in your pocket.
Wow.
So that's a big deal. And people are missing it. And they're primarily missing it because they're accountants who are too lazy to do a home office and don't understand the rules, are not saying, have a home office, go to your home office first thing in the morning, stop at your home office last thing at night, and in between, do your real estate. And now your car becomes a major tax deduction.
I was envisioning myself, so I'm 5'5" and like 130 pounds wet. I was envisioning myself in one of these like $80,000, like the Toyota Tundras or like the massive GMC Jimmys or whatever. I would look like a 16-year-old child driving this thing. I think would be nuts. But
how much fun would you have doing it?
I would have a blast. It would be great.
There you go.
Yeah.
There you go. Put lifts on it. Put big wheels on it.
It'd be so
Knock
great.
yourself out, Abhi. I think it'd be awesome.
I feel like my very own Tonka truck. All right. So we've got maybe about 30 seconds, 45 seconds, and I know there's so much more information here. What's one more tax deduction that real estate investors are not taking advantage of right now?
I think a big one right now is travel, because typically when you're a real estate investor, wherever you go, you're looking at real estate. And as long as you spend more time looking at real estate than you do vacationing, so 4.5 hours a day during the week, you get to deduct the entire travel, as long as it's within the US, the entire amount of your travel expense, just for you, not for your spouse, not for your kids, but your entire, your airplane ticket, your rental car, your hotel, your meals, all of that is deductible if you spend 4.5 hours a day or more looking at real estate, because you're a real estate investor. And who knows, you might find a deal.
Awesome. Tom, thank you so much for the insights. I know there are so many more things to cover, like the historic building tax credit, the low-income housing tax credit, and some of the questions that you should ask here. And opportunity zones. I'd like to invite you back. We'll talk about those things specifically and the opportunity zone piece, because there's a lot of conversation around that needs to happen right now, especially for real estate investors. So we need to have you back. Think Realty Nation, you want to get in touch with Tom Wheelwright and his team, go to www.wealthability.com, schedule a consultation. And Tom, is there like a button that I click on?
There is. It comes right up front. It's above the fold button. Just click on it, schedule a consultation, and you can do it directly. You don't even have to talk to anybody. You can just go schedule a consultation when it fits in your schedule. That's awesome. Tom, thank you so much. Your insights are super valuable, and I rely on them on a regular basis. So thanks again. I appreciate all the work that you do. Anytime, Abhi. Take care. Bye-bye. Tom Wheelwright, everybody. You want to get in touch with him? Again, WealthAbility.com.
This next segment is brought to you by Real Property Management, which is the largest residential property management franchise in North America, managing tens of thousands of properties for individuals, investors, and institutions throughout the country. Learn more at realpropertymgt.com. That's realpropertymgt.com. Or call 888-806-7088. I want to talk about winning the real estate game by setting the right goals. And it starts with goals. And there was a Forbes article that talked about this goal-setting idea. And I mean, again, kind of super basic, right? Number one, set your goal. Number two, establish your criteria. And number three, build your network. But I think for me, it goes a lot deeper than that. Simon Sinek had a really viral YouTube video titled Start With Why. And I think it's more than just setting the goal. I think the goal is the result of why you are doing something. And you might be in the real estate game because you want financial security. You want financial certainty. You want to know that at the end of the day, you can handle anything for you, yourself, your family, your kids, etc. Maybe you want to donate some time. Maybe you want to donate to a charity. Maybe you want to tithe more. Maybe you want to travel the world. Doing mission trips, whatever that looks like for you, changing the face of education, changing the face of healthcare because you deem that important. I think starting with why here is the most important thing, and then setting goals that really reflect the true heart of your why. So consider that we're getting into goal season now, even though everybody should be reviewing their goals and adjusting their goals throughout the year. We're getting into that 2020 goal season. Jump into that hot and heavy. Understand your why, understand the goals that you can write according to your why that really reflect the heart of your why, and then start executing on them day by day. If you want to be held accountable to this, certainly feel free to get in touch with me anywhere online at Abhi Golhar. You can also visit www.thinkrealty.com/podcast to watch some of the other awesome shows and amazing episodes that we've had here on the podcast. And of course, you know, I want you to do this stuff. You know, we don't just burn out our voices and look good for TV or the camera on a daily basis just so you can chill out and say, oh, I'm not doing anything. No, I want you to take some action. So take some action and then tell me how it went at Abhi Golhar anywhere online, all right? So that's the show. You want to get in touch. You know how to do it. And I want to give a huge shout out and thank you to our sponsor, Narada Real Estate Investments, for today's show. Narada Real Estate Investments is your premier source for cash flow investment property. Go to www.turnkeyrealestateinvestments.com to learn more. Think Realty Nation, that's a wrap. Happy investing.